So hello guys, let us continue with our class for financial reporting and analysis. Uh, our previous class we did a question on one of the past paper that was for April 2025, April 2025 question number 5B. So today we are going to proceed and do another question. So we are going to proceed and do another question. So we are going to proceed and do another question. And to be specific, we shall do a question for December 2024, question number 3. December 2024, question number 3. December 2024, question number 3. December 2024, the question is question number 3. So, December 2024, the question was question number 3. So, we shall do December 2024. The question is question number 3. So, let me read the question. So, a draft financial statement set out below to be Bitaito Limited, a public limited company. So we have the statement of financial position as at 31st October. We have for the 2023 year and for 2024. That is for comparative purposes. Then we have an extract of the statement of P&L and other comprehensive income. That is for 2024. Then additional information. So we shall focus on the additional information before we do the question. So let's start with the first additional information. During the year ended that 1st October, the director of the company accepted a revaluation report at a gain of 4.5 million. The company does not make the inter-reserve transfer for excess depreciation upon revaluation. So you can confirm that revaluation of 4.5 in our financial statement of financial position. So if we go to the statement of financial position under equity and liabilities, you can check that we have the revaluation reserve. So revaluation reserve at the beginning was 5,000. At the beginning was 5,000. At the end is 9,500. So that increase is the revaluation which we have been told in the additional information. So that is the so if not not said, you check in your equity component and the revaluation surplus or the revaluation reserve. So from 5,000 to 9,000, that is 4,500. That one is okay. This revaluation will affect the PPE account. It will affect the PPE account. That is information number 1. We are done with it. Number 2, depreciation for non-current assets charged to the P&L amounted to 2.7, 2,780,000. So we have been given the depreciation. That is good. Now, because we have the depreciation, we can compute now. We can come up with the PPE account. So let us come up with the PPE account. PPE account. And remember, it is on net book value. Remember the PPE because it is provided in the statement of the financial position as at the end. Then the values of the PPE are in net book value. They are in net book value. So let me shift it a bit so that we save on space in case the working becomes. So PPE, so it is in net book value. So so the balancing figure at the beginning is always on the debit side for PPE or the assets. So what is the balance at the beginning for PPE? So in that PPE balance at the beginning is 54,160. 54,160. Then you have the balance at the end. Balance carried down. The balance at the end is 72,475. 72,475. Then we need to cater for depreciation for the year. For the year. Depreciation for the year. So what was the depreciation for the year? It was 2780. Depreciation for the year was 2780. 27. The provision for the year was 2780. I think that one is correct. Do you have any? Did we have disposal? Before we go to disposal, we have revaluation. In this case, revaluation, which we saw that revaluation was information number 1 for 4500. So we had a revaluation of 4500. So remember, Kama, you have not been given the information about revaluation in additional information. You check the equity and liabilities and the revaluation reserve. So if we have an increase, just know there is a revaluation. Now let us check if there was a disposal. Information number 1 we have done. Number 2 complete. Number 3, during the year ended at 1st October, a new patent was acquired. So that one is another information. Number 4, an investment held by Beto is measured through the fair value through P&L. Neither purchase nor sale of investment occurred during the year. So that's the fair value investment, but there was no acquisition or disposal. That information is not important to us because there was no acquisition or disposal, because there was no any acquisition or disposal. So let us balance this account. There's no any other item affecting this account. So 2780, we add 72 for 75. Then we go to 75 to 55. 75 to 55. Then we have acquisition of. So the balancing figure becomes acquisition of PP. Acquisition of PP. So that becomes the balancing figure. So let's see the balancing figure. 54,160 plus 4,500. Then we less that figure. 16. It is 16,595. 16,595. That one is okay. Then we had something to do with intangible asset. That was information number 3. A new patent was acquired. So let us see the patent. So the patent will affect the what we call the intangible asset. So intangible asset account. So intangible asset account. It's an asset. So the balancing at the beginning is on the debit side. So the balance at the beginning for intangible asset is 12 to 40. 12 to 40. Then balance carried down, that is at the end, was 15. 15,700, that is correct. Then we have been provided some information in our additional information number 3 that there was an acquisition of intangible asset. Acquisition of intangible asset. So the acquisition of intangible asset was for how much? 4 million. So in thousand, we put it in thousand. That is 4,000. So then we balance this account. There's nothing else affecting this account. So the balancing figure will be amortization. So the balancing figure will be amortization on the other side. So the balancing figure will be amortization. So 12 to 40 plus 4,000, that is equal to 16 to 40. 16 to 40. 16 to 40. Then the balancing figure will be amortization. So minus 15,700. Amortization is 540. So that is the balancing figure, which is amortization. Information number 4, it is of no importance to us because the investment is measured in fair value. That is okay, but we don't have any evaluation concerning that one, and there is nothing concerning acquisition or sale. So that information is not of relevance to us. Now we can check for other information. For example, we can come up with a tax account. Tax account to determine the tax payable in the year, in the period. Let us determine how much they pay in terms of tax. So tax paid. So we open tax account. So we need to open tax account. So we start with the balance brought down. We need to consider if there is deferred tax and the current tax. So in this case, yes, we have both deferred tax. So we start with the deferred tax and the current tax. So DT means deferred tax, CT means current tax. By an exam, you can write in full. So it is 1955. 1955. What about the balance at the beginning for current tax? 1485. 1485. Then balance carried down. Balance carried down. So we have DT and we have CT. DT is the deferred tax. Now DT at the end, it is 2370. 2370. 2370. The other one is 1880. 1880. Then we check for the tax in the income statement, so the P&L. So the tax in the income, so tax expense is 1330. So P&L, tax is 1330. So right, P&L 1330. So once we have that one, we can balance the account. The balancing figure will be the tax paid. Tax paid. That will be the balancing figure. That will be the balancing figure. So let us balance it. So 1955 plus 1485 plus 1330, that is 4770. 4770. Then we can less 2370 and 1880 to get the balancing figure, which is equal to 520. So the tax paid during that year equals to 520. We can open another account. Let me see if we have another account which is important. We can open the retained earning account. We can open the retained earning account to see if there was a dividend paid. So retained earnings account. So retained earnings account. So balance brought down, then balance carried down. So what's the balance at the beginning for retained earnings? So if you go check the retained earnings, the balance at the beginning is 14,755. 14,755. 14,755, and then at the end is 17,505. 17,505. Now we can balance this account. Now before we balance, we need to check the profit after tax. So profit after tax is the account which affects this item, which is 33, 35. Then we can balance 33, 35. So 33, 35. Now let us balance this account. So the basic figure will be equal to a dividend paid. Dividend paid. So let us compute and see how much was the dividend. So 14,755. 14,755 plus 3335, that is 18,090. 18,090. 18,090. Then we less 17,505. It is 585. 585. I think we are done with all the additional information required. I think now we can proceed and do the consolidated statement of cash flow. The consolidated statement of cash flow. That one is fine. Okay. That one is fine. Now let us move on. So there was no any acquisition or disposal for any other thing. So let us write the required. So tunasema Betright Limited. So we say Betright Limited consolidated statement of cash flows for the year ended Now, what was the year ended? 31st October 2024. 31st October 2024. The amount is in Kenya shillings, 1,000. So the amounts are in Kenya shillings, and that is in 1,000. So we start with the profit before tax. That is cash flow from operating activities. So we say cash flows from operating activities. So we start with the profit before tax. Profit before tax. Now, the profit before tax, it is 46.65. So 46.65. Then we do adjustments. Adjustment for the first one is depreciation kama kawaida. Depreciation for the year. And depreciation for the year, we have it here. It's 2780. So depreciation was deducted. We add it back. 2780. We have amortization also somewhere. Amortization. It was deducted. We add it back 540. We have it here. What else do we have in this account? There's nothing else. But we go back to our income statement. So we have the fair value on investment, fair value gain. Fair value gain on investment. Now it was added, so we need to deduct it. It is 325, so we deduct it. I think and then finance cost. We need to check for finance cost or the interest paid. So finance cost is also called. You can call it the interest paid. So you go to the P&L also. So in the P&L, the finance cost is 1,200. It was deducted, so we add it back. So 1,200. So add them together. So itakuwa ni 4665 plus 2780 plus 540 minus 325 plus 1,200. Itatupatia 8860. 8860. Then we do the working capital changes. We do working capital changes. So we start with we check for current assets, that is receivables and inventory. Inventory and receivables. Inventory and receivables. So we have to start with the receivables. Now receivables, it was 7,040. It increased to 74. So we have an increase in receivables. So what is the increase? Let us see. 7485 minus 7040. 7485 minus 740. Then we have receivables also increased. So increase in so this one is in inventory. In inventory. And then we have an increase in receivables. An increase in receivables 6030. 6030 minus 5830. 5830. So as the year started, it was 5830. It usually equals 6030. So that's an increase. Then we check the other one. Payables, current liabilities. What have I done? Okay, also it also increased for payables. Okay, so payables, it was 3505. It kind of back 4645. So it increased from 3505 to 4645. So also we have an increase in payables. So that will be equal to 4645. 4645 3505. So let's do that working and see. So 7485 minus 7040. That is 4445. So we less. Why are we lessing? When inventory increases, it means we purchased more. So when we purchase, that's an outflow. Same to receivables, because it's an asset. We argue the same way. So we also less 200. Then the opposite is applicable for the other one, 1140. So the opposite, we add it back. Now, once we do that one, we shall get what we call the gross cash flow from operation. So how much is that? So 8860 minus 445 minus 200 plus 1140. That is 9355. Now we can less tax. Tax paid. We also less interest paid. So tax paid, we have it there, 520. The interest was 1,200. Now once we have that one, I think we can get now the cash flow from net cash flow from operation. So net cash flow from operating activities, and then we call it A. So what will be the figure? So 9355 minus 520 minus 1200, 76, 35, 76, 35. Then you can go to the cash flow from investing activities. Cash flows from investing activities. Cash flows from investing activities. Now, for investment, so you put things like dividend received, any acquisition. For example, we had an acquisition of PP. Acquisition of PP. So that's money out. 16. When you acquire something, you pay. That's money out. We also have acquisition of intangible asset. Acquisition of intangible assets. Acquisition was 4,000. This one was 4,000. What else? Dividend paid. So dividend paid is under financing, but if you have dividend received, unaweka hapo. So we don't have any other items. I think in that case, those are the two items available. So we can get the final net cash flow. Net cash flows from investing activities. Investing activities, and then we call it boy. We call it boy. So minus 16,595 minus 4,000. That is minus 20,595. So we have a negative figure of that amount. Minus 20,595. Then we can do the last part. We can do the last part. The last part is cash flow from financing activities. Cash flows from financing activities. The first one which you need to know is the issue of number one, share capital, and the other one, do we have share premium? Let me check. Yes, we have premium. So it was how much? It was 40,000. It has increased to 50,000. So meaning the big difference. So 50,000 minus 40,000. There was no issue of share of bonus or in that one. So kama hakuna, it will be 10,000. It's an increase. So it's a positive figure. Then you have share premium. Share premium. Now share premium at the beginning it was 5,000. At the end, sorry, at the beginning it was 10,000. At the end it was 12. So it has increased. So at the beginning was 10,000. At the end 12,000. So 12,500. So it has increased from 10,000 to 12,500. That is 2,500. So that's also an issue. That's money in. Apart from the equity and liabilities, what else can we see? We have a long-term borrowing. We have long-term borrowing. Long-term borrowing. Now, at the beginning, because there is no additional information concerning those items, so we do them direct. So long-term borrowing, it was 10,300 at the beginning. At the end, it's 11,600. So it's an increase. An increase means you have borrowed more money. So the borrowing is an inflow. So when you borrow, so 11,600 minus 10,300, that is 1,300. It means you borrowed. I think that is all about it. Do you have any other item? I don't think so. Those are the items. Oh, we have dividend. Dividend paid. Dividend paid. So we said that if you have dividend received, or it is under investing, but if the dividend was paid, it's under financing. So dividend paid, we come out to retained earnings is 585. So that one was paid. So it is money out. Now once we have that one, we can get the net cash flow from financing activity. Net cash flows from financing activities. We can call it C. We just call it C. So what do we do? So we add them 10,000 plus 2,500 plus 1,300 minus 585. That is 13 to 15. 13 to 15. Once we have that one, now we can get the net cash and cash equivalent. Net cash and cash equivalent, that is A plus B plus C. So let us add them, A plus B plus C. So A is 76.35 minus 20, 595, then plus 13,215. We are getting amount of 255. 255. That is the net cash. The cash equivalent. Now we need now to include now the opening balances and the ending balances. So open. So let's go back to our statement. So when you go to our statement under current assets, cash and cash equivalent at the beginning is 2230. So we start with cash and cash equivalent. Equivalent at the beginning is how much? 2230. So add 2230. So you add the two. What you get must be the same as the ending balance in our statement. So what's our ending balance? So cash and cash equivalent at the end, and cash equivalent at the end. So at the end, from our statement, from our balance sheet, at the end natuambia ni 2485. 2485. So is it the same when you add? Let us confirm. So hizi mbili, these two items, we obtain them from the statement. So we obtain them from our balance sheet. So let's confirm if it's the same. So 255 plus 230, 2485. That one is correct. So that one is correct. So remember, when you take net cash and cash equivalent, then you add the opening cash and cash equivalent, you will need to get the closing cash and cash equivalent. So these two items, these are the balances, the bank balances in the balance sheet. So kama ujue penye hii inatoka, this is the bank balances in the bank balances in the statement of the financial position. Anyway, that one is all about that question. So that question is done. So that question is done.